Hey everyone, GP here from the Financial Breeze Show. Have you noticed something strange happening in the housing market? People are hitting the brakes on buying homes. It's like everyone's waiting for something. But what? Today we're diving deep into the psychology of the housing market. We're going to break down why so many people are hesitant to buy right now. And more importantly, we'll explore what this means for the future of real estate. Get ready to level up your real estate knowledge because understanding these trends can make a huge difference in your financial future. So let's get started. One word, interest rates. They are the heartbeat of the housing market, influencing every decision from buying to selling. They're like the puppet master of the housing market, pulling the strings that determine affordability and demand. Right now, rates are higher than they've been in a while, creating a ripple effect throughout the market. This makes borrowing more expensive, which scares off potential buyers. Higher rates mean higher monthly payments, and that can be a deal breaker for many. But here's the catch. Many experts predict that interest rates will drop in the coming months or years. This potential drop is a beacon of hope for those waiting on the sidelines. And when those rates go down, watch out. The market could see a surge in activity as more people can afford to buy. Lower rates mean lower monthly payments, making homes more affordable for a wider range of buyers. This affordability can open the doors to home ownership for many. This increased demand can lead to one thing: higher home prices. More buyers competing for the same homes can drive prices up. It's a classic case of supply and demand. When more people want to buy, but the number of homes stays the same, prices naturally rise. So, while high interest rates might seem like a buzzkill now, they could be setting the stage for a future price surge. The market is always in flux, and today's challenges could be tomorrow's opportunities. I know what you're thinking. Graham, higher interest rates sound terrible. They make borrowing more expensive and can seem like a huge barrier to buying a home. Why are you saying they're a good thing? It sounds counterintuitive, right? Hear me out. While higher rates aren't ideal for buyers in the short term, they're actually playing a crucial role in keeping the market stable. They help to moderate the pace at which home prices increase. Remember the insane housing market of the past few years? Prices were skyrocketing, making it nearly impossible for many people to afford a home. The market was overheated and something needed to change. High interest rates act like a speed bump, slowing down the market and preventing another unsustainable price bubble. They help to curb excessive demand and keep prices from spiraling out of control. Think of it like this. Higher rates are like a pressure valve, releasing some of the excess demand and preventing the market from overheating. This helps to maintain a healthier balance between supply and demand. This cooling off period gives buyers a chance to breathe and reassess their options. It allows for a more thoughtful and less frantic approach to home buying, which can ultimately lead to better decisions and more affordable housing in the long run. Now, let's flip the script and talk about sellers. They're in a tough spot too. Many sellers locked in incredibly low interest rates when they bought their homes. Now they're hesitant to sell because they don't want to give up those sweet low rates. They're holding out, hoping that either prices increase even further or that interest rates drop, making their homes more attractive to buyers. It's a classic game of chicken. Who will blink first? This seller standoff is another factor contributing to the current market slowdown. But remember, markets are cyclical. Eventually, something has to give. Section 5. Crash Course. Why a housing market collapse is unlikely. Okay, let's address the elephant in the room. Is a housing market crash on the horizon? While no one has a crystal ball, there are several reasons why a full-blown crash is unlikely. First, we need to understand what caused previous crashes. The 2008 crash, for example, was fueled by irresponsible lending practices, subprime mortgages, and a lack of regulation. Today, the lending landscape is drastically different. Lenders are much more cautious now, requiring higher credit scores and larger down payments. This reduces the risk of borrowers defaulting on their loans, making a widespread collapse less likely. Section 6. The inventory equation. Low supply, steady demand. Another reason why a crash is unlikely is the simple issue of supply and demand. Right now, we have a significant housing shortage. There just aren't enough homes to meet the demand, especially in desirable areas. This low inventory creates a floor for prices. Even if demand cools off slightly, the lack of available homes will prevent prices from plummeting. Think about it. If there are only a few houses for sale and a lot of people who want to buy them, those houses will still command a premium. This supply-demand imbalance is a key factor supporting housing prices even in the face of rising interest rates. Section 7. Economic stability, learning from past mistakes. Remember the economic turmoil of the past few years. The pandemic, inflation, and global uncertainty have definitely left their mark. However, there are signs that the economy is stabilizing. The Federal Reserve has been raising interest rates to combat inflation, and while this has impacted the housing market, it's also a sign that they're taking steps to control the economy. Furthermore, we've learned valuable lessons from past economic crises. Governments and financial institutions are better equipped to respond to potential threats and prevent a full-blown recession. Section 8. The side hustle factor. More income, more options. Here's something you don't hear every day. The rise of the side hustle is actually impacting the housing market. More and more people are generating income from multiple sources, whether it's freelancing, driving for a ride-sharing service, or starting an online business. These side hustles provide a financial cushion. This extra income gives potential home buyers more flexibility and purchasing power. Even if interest rates remain elevated, those with side hustles have an additional income stream to offset the higher costs. This trend towards diversified income is another factor contributing to the resilience of the housing market. Section 9. The bottom line. Don't wait for a crash, make a plan. So what's the takeaway from all of this? It's simple yet profound. First, don't wait for a crash that's unlikely to happen. The idea of waiting for a market crash can be tempting, but it's not a reliable strategy. The fundamentals of the housing market are strong, and while prices may fluctuate, a catastrophic collapse is not in the cards. Historical data shows that the market has its ups and downs, but a complete meltdown is rare. Second, focus on what you can control. This means taking proactive steps to prepare yourself for home ownership. If you're thinking about buying a home, get your finances in order, work on improving your credit score, and save for a down payment. These steps will put you in a strong position when the right opportunity arises. Finally, stay informed. The real estate market is constantly evolving, so it's crucial to stay up to date on the latest trends and news. Subscribe to newsletters, follow market analysts, and keep an eye on economic indicators. And hey, while you're at it, don't forget to like this video, subscribe to the channel, and hit that notification bell so you never miss an update. Staying connected with reliable sources can make a big difference. Remember, knowledge is power, especially when it comes to real estate. The more you know, the better equipped you'll be to navigate the market. By understanding the forces at play in the market, you can make informed decisions and achieve your financial goals. Whether you're a first-time homebuyer or a seasoned investor, staying educated is key. Until next time, happy investing. Keep learning, stay proactive, and make the most of the opportunities that come your way.